In this video, you will learn about the common tax filing mistakes and the Voluntary Disclosure Programme. It is important for companies to file complete and accurate corporate income tax returns, as there are serious consequences for filing incorrect tax returns. A penalty of up to 200% of the amount of tax undercharged may be imposed for an incorrect tax return filed. Both Selina and Bobby, directors of SE Pastries Private Limited and BB Bakery Private Limited, respectively, would like to find out some of the common filing mistakes to avoid when filing their corporate income tax returns. Let's take a look at the first common filing mistake: understatement of income. Companies who fail to keep proper records tend to understate their income by omitting certain receipts or invoices. Your company must maintain proper records of its financial transactions and retain its accounting records and supporting documents for at least 5 years from the relevant year of assessment. Using an accounting software improves record keeping and tax compliance. You may refer to the IRAS Accounting Software Register Plus for the list of software that allows you to manage your day-to-day business operations and transactions digitally, as well as enable you to fulfill your company's tax obligations seamlessly. The second common filing mistake is wrongful claims of non-deductible expenses. Some examples include motor vehicle expenses. For example, companies may wrongly claim tax deductions on private car expenses. All private car expenses incurred, such as petrol, insurance, road tax, parking, and ERP charges, are not tax deductible, even if the car was used for business purposes. These expenses have to be added back to the tax computation when arriving at the adjusted profit. This also includes the cost of reimbursing your employees when they use their own private car for business purposes. However, if your company provides a monthly transport allowance to your employees, this amount will be tax deductible. Do remember that your company will need to declare the transport allowance in your employees' form IR8A. Another common mistake is the claiming of tax deductions for general provisions, such as general provisions on stock obsolescence. General provisions are not tax deductible, as these are estimated amounts. Companies are required to add back the general provisions in their tax computations and only claim a tax deduction when the amount is utilized. Companies should maintain supporting documents to substantiate the claim. Next, let's look at the common mistakes that companies often make when claiming tax deductions on renovation or refurbishment or R&R works. These are also known as Section 14N deductions. Companies should not claim non-qualifying items such as designer fees, professional fees, any type of fine art or antiques, and R&R works where an approval of the Commissioner of Building Control is required. Companies should also ensure that their Section 14N deductions do not exceed the cap of $300,000 for every relevant 3-year period. Lastly, other non-deductible expenses include personal or private expenses, depreciation, statutory fines and penalties, and legal and professional fees incurred on capital transactions. After learning about the common mistakes, what should you do if you discover an error after filing your company's corporate income tax return? Don't panic. The IRAS Voluntary Disclosure Programme, or VDP in short, encourages taxpayers who have made errors in their tax returns to come forward voluntarily in a timely manner to correct their errors. IRAS is prepared to reduce the penalties for voluntary disclosures which meet the qualifying conditions. To qualify for the IRAS VDP, you will need to submit a voluntary disclosure that is timely, accurate, complete, and self-initiated. This means that your company must make the disclosure before it receives a tax query from the IRAS or before it receives a notification from the IRAS on the commencement of an audit or investigation on its tax matters. After submitting a voluntary disclosure, you must cooperate fully with the IRAS to correct the errors made and make arrangements to pay the additional taxes and penalties, if any, and honor such arrangements till all payments are made in full. If the voluntary disclosure is made within 1 year from the statutory filing deadline, no penalty will be imposed, provided that the company has met all the qualifying conditions as mentioned. If the voluntary disclosure is made after the 1-year grace period from the statutory filing deadline and all the qualifying conditions are met, a reduced penalty of 5% of the income tax undercharged will be imposed for each year the error was late in being rectified. BB Bakery has discovered an error for its YA20X1 corporate income tax return on 1st November 20X2. The tax undercharged was $1,000. BB Bakery made a voluntary disclosure to the IRAS on 10th November 20X2. As BB Bakery had informed the IRAS within 1 year from the statutory deadline of 30th November 20X1, no penalty will be imposed on the tax undercharged provided all the qualifying conditions are met. However, if BB Bakery only made the voluntary disclosure on 20th December 20X2, this would be after the 1-year grace period from the statutory filing deadline of 30th November 20X1. Hence, the reduced penalty of 5% of the tax undercharged will be imposed. That works out to be $50. Let's recap. Companies are strongly encouraged to keep proper records and make the necessary tax adjustments when filing the corporate income tax return. There are serious consequences for filing incorrect tax returns. A penalty of up to 200% of the amount of tax undercharged may be imposed for an incorrect tax return filed. The IRAS Voluntary Disclosure Programme encourages taxpayers who have made errors in their tax returns to come forward voluntarily in a timely manner to correct their errors. IRAS is prepared to reduce penalties for voluntary disclosures which meet the qualifying conditions. You may visit the IRAS website or contact us for more information.